Have you ever wondered why some people start trading with so much hope, but end up losing everything? Not just money, but also their peace of mind. Why some people don't lose because they lack knowledge. They don't lose because they lack a strategy, but they lose because of one decision that seems so logical: borrowing money to trade. They think, if I'm good, if I have a system, if I just need a little more capital, then profits will grow very fast. Sounds reasonable, sounds smart. Sounds like a step forward. But the truth in trading does not operate by the logic of greed, and the price of borrowing money to trade is not just money, it is psychological suffocation. It is fixed interest pressure. It is the feeling of, I must win. It is stepping into the market no longer as someone managing probabilities, but as a gambler who needs to win it back. In a margin market, leverage is an illusion. Margin calls are an illusion, but the money you lose is real money. But you can see the numbers jump on the screen. Plus 5%, plus 10%, plus 30%. It feels amazing, so fast, so powerful. But when the market turns 5%, 10%, 30%. And because of leverage, that negative number is no longer a small scratch. It is a stab. Leverage is a double-edged knife. It can amplify a positive number into a very large positive number, but it can also amplify a negative number into an abyss. The problem is, in trading, there is no absolute win. There is only probability. You can have a system with a 60% win rate, 70%, but never 100%. There will always be losing streaks. There will always be drawdowns. There will always be days when the market moves against you. And when you use spare money, you can endure that losing streak. You can say, okay, this is probability. I still have capital. I still have a chance. But when you use borrowed money, you don't just endure drawdown. You endure time pressure. You endure interest pressure. You endure the pressure to win. And when your mind is under pressure, every principle you learned starts to crack. I once witnessed a friend. He traded Forex. At first, his capital was small. He traded with discipline. Each trade risked 12% of the account. He stayed calm when he lost. He didn't get overly excited when he won. The account grew steadily. Then one day he thought, if I had an extra $10,000, then my monthly profit would be 34 times bigger. He borrowed money, fixed interest, fixed pressure. From that day, then everything changed. It was no longer trading by the system. It became trading by emotion. All it took was one strong candle against him, and his heart started racing. All it took was one trade going deeper negative than expected, and his hands shook. All it took was one unfavorable news event, and his mind became chaos. And the most painful part, when the trade was in profit, he couldn't hold it, because he was afraid of losing it back, afraid of losing borrowed money, afraid of losing effort, afraid of losing the chance to repay. But when the trade was in loss, he held on obsessively, because he couldn't accept losing borrowed money. He couldn't accept that he was wrong, and leverage amplified that negative number many times over. This is a brutal psychological paradox in trading. When leverage hits a positive number, most traders cannot hold long enough to reach a huge positive number. But when it hits a negative number, they hold the loss. They DCA. They increase size. They hope. They pray. Because behind it is not just money. It is debt repayment pressure. It is pride. It is, I cannot lose. And you know what is the worst part? Raising capital to trade, paying fixed interest, means you already used margin once. You already entered the game with pressure built in. Then you enter a margin market and use leverage again. That means you are doubling the pressure, doubling the risk, doubling the chance of losing control. You are standing between two layers of leverage. At one layer from the lender, one layer from the broker. And if the market shakes hard enough, everything collapses very fast. I have seen people borrow from banks, borrow from relatives, even put their house papers at risk. At first they say, I'll just trade short term. I definitely have a plan. I won't be reckless. But trading is not a place for definitely. Trading is a place where you manage risk. The moment you put yourself in a position where you must win, you have already lost your ability to manage risk, because every decision then is no longer based on probability. It is based on fear and hope. A professional trader understands one thing very clearly: survival first, profit later. If you don't survive long enough, no system can save you. Raising capital and borrowing to trade is a forbidden zone, not because you cannot make money, but because it destroys the psychological foundation. It turns trading from a long-term probability game into a short-term race against time. It turns you from the one controlling risk into the one controlled by pressure. I once read about the story of Jesse Livermore. He made and lost many fortunes. What kills many traders is not that they don't understand the market. It is that they cannot control themselves when risk exceeds their tolerance. Borrowing money to trade is the fastest way to push risk beyond your tolerance. You might say, but what if I'm good? That question sounds confident. But even good traders still have losing streaks. Even large hedge funds still have drawdowns. Even full-time traders with 10 years still have negative months. The difference is, they use money they actually have. They don't trade with money that carries monthly interest. They don't trade with money they must explain to their family. They don't trade with the feeling, if I lose everything. Trading is already a nervous system game. The more you increase outside pressure, the weaker your nervous system becomes. And when the nervous system is weak, skill disappears, discipline disappears, patience disappears, the system disappears. All that remains is a person sitting in front of the screen with a debt behind their back and a market that does not care who they are. The market doesn't know you borrowed money. It doesn't know you have interest to pay. It doesn't know you are under pressure. It only moves by supply and demand, by liquidity, by big money flow. And if you stand on the wrong side, it will sweep you away. No negotiation, no mercy. So, never borrow money to trade. If you don't have enough capital, reduce your position size. If you want big profits, increase your skill first. If you want to go far, protect your nervous system. Trading is not a contest of who is more reckless. It is a game of who survives longer. Borrowing money to trade can give you the feeling of moving fast, but many people move fast, straight into the cliff. And when it's gone, it's not just money that's gone. It's trust, it's family, it's time, it's self-respect. A mature trader understands very clearly. Opportunities will always be there. The market will still open tomorrow. But if you blow up your account and carry debt with it, you no longer have the chance to return with a healthy mind. Trading is a business of price movement. A business needs capital, but capital must be money you can accept risking, not money you must repay, not money you are terrified to lose, not money you are not allowed to be wrong with. Because in trading, being wrong is part of the game. If you don't allow yourself to be wrong, the market will teach you in the most brutal way. And that lesson is expensive. When you borrow money to trade, you are not just borrowing money. You borrow pressure. You borrow time. You borrow other people's expectations. And the most dangerous thing you borrow is the feeling, I'm not allowed to lose. Trading is, by nature, a probability game. But the moment you put money on the table that demands fixed interest every month, you turn a probability game into a game where you must win. And that is where every tragedy begins. Imagine two traders. The first one trades with spare money. He knows every trade risks 12%. If he loses 5 trades in a row, the account drops 810%. He uncomfortable, but acceptable. He can still sleep, still eat normally, still review his trading journal, still ask, where was I wrong? The second one trades with borrowed money, fixed interest, a clear payment date, 5 losing trades in a row, is no longer 810%. It becomes, how do I pay this month? How do I tell my wife? How do I face the lender? At that point, trading is no longer market analysis. It is fighting fear. And when you trade in fear, you no longer see market structure. You only see negative numbers. You no longer see probability. You only see time. I've said this many times in previous content. Trading is nervous system management, not indicator management. And borrowed money is the fastest thing that destroys the nervous system. When your account is down with spare money, it hurts. But when your account is down with borrowed money, you panic. And in panic, the human brain does not make logical decisions. It switches into survival mode, fight, flight, and freeze. You will either increase size to recover fast, or close trades early out of fear, or freeze and refuse to cut losses. These three reactions all kill accounts. There is a cruel paradox. When traders don't use borrowed money, they usually cut losses better, because they accept losing as part of the system. But when traders use borrowed money, they cannot accept loss, because each losing trade is not just a wrong setup. It is losing someone else's money. It is losing credibility. And it is losing face. So they hold. They hold because of hope. They hold because of fear. They hold because they don't want to face reality. And the market has no compassion for hope. I once met a case, a crypto trader. In a strong bull market year, he borrowed money from friends, then used 10 times margin. One upward wave, and the account grew extremely fast. He made money that used to take years. It felt powerful. It felt right. It felt confident. And that feeling was the seed of collapse, because he started to believe, I understand the market now. But the market doesn't go up forever. When the wave reversed, the margin call arrived very fast. Not slowly, not gradually, but collapsing within hours. Not only did he blow up the account, he carried debt behind it. The most painful part wasn't losing money. It was losing everything he had earned before, and then going negative on top of it. Leverage has one characteristic. It amplifies everything, not just profit, but emotion. When you win big fast, dopamine spikes. You become addicted to that feeling. You want more. When you lose big fast, cortisol spikes. You get stressed. You lose sleep. You lose control. When trading feels like an emotional roller coaster, it's a sign you're taking risk beyond your nervous system capacity. Borrowing money to trade is the fastest way to push risk beyond the tolerance line. There is a truth few people say. Fixed interest is the enemy of volatile profits. Trading profits are not even. There are profitable months, break-even months, negative months. But borrowed money doesn't care if you're up or down. It demands payment on time, and that mismatch is the deadly contradiction. You are playing a long-term probability game, but you place on top of it a short-term obligation. You are growing a tree that needs time, but you must pay rent every day. That pressure turns trading into a race, and in that race, you rush the process. You increase size, increase leverage, choose higher risk setups, skip rules, because you think, I just need one big trade, and many accounts die from just one trade. A mature trader understands, no single trade will save you, and only long-term discipline will, and discipline cannot exist when you are under debt pressure. People ask me, so what if I'm very confident in my system? Then I ask back, can you accept 10 consecutive losses? Can you accept a 20% drawdown? If your answer is uncomfortable, but I can, then maybe you're using suitable capital. If your answer is I can't handle that, then you are risking too much. And if you borrowed money, the answer is almost certainly I can't. A 60% win rate system can still have a 78 loss streak. A great system still has periods when the market doesn't fit, but a trader who borrowed money doesn't have the luxury of time. They need the market to fit right now. And the market never promises that. Don't confuse confidence with necessity. Confidence means you know you have an edge. Necessity means you need the market to pay you. Those are completely different states, and the market rewards confidence. It punishes necessity. There is a crucial concept in trading, risk of ruin. When you use spare money and manage small risk of ruin is low. When you use high leverage, risk of ruin increases. When you borrow money and use leverage, risk of ruin spikes. You're not just risking an account, you're risking the life behind it. I'm not saying never use leverage. Leverage is a tool, but only when you have enough capital, enough experience, enough nervous system strength, and most importantly, no outside pressure. But if you're thinking, I'll just borrow a little, stop and ask yourself, if I lose that money completely, what happens to my life? If the answer is, my life will become very difficult, then you should not do it. Trading is not a quick escape from poverty. It is a long discipline path. And the paradox is, when you stop rushing to get rich, you finally have a chance to get rich. But when you borrow money to get rich fast, you put yourself in the weakest position. A strong trader trades in a state of not needing to win. A weak trader trades in a state of needing to win. Borrowing money to trade turns you from strong to weak. Because you put your neck under the blade of interest, and with just a small market shake, you lose balance. Wanting to be fast. That is the root of every decision to borrow money for trading. No one borrows money to trade if they are truly patient. No one chooses interest pressure if they understand trading is a long-term game. The problem is not leverage, not margin. The problem is the psychology of shortening time. You see people showing profits. You see accounts doubling in months. You see big numbers. And in your mind, you start calculating, if I had more capital, I could do that too. But you don't see the hidden part. You don't see the losing streaks, the sleepless nights, the previous blow-ups, the silent years of practice. Trading on social media is smooth upward curves. Trading in real life is jagged saw teeth. And if you can't accept those saw teeth, you will try to smooth it with leverage. But leverage doesn't smooth, it sharpens. It sharpens both profit and loss. There is a rule every long-time trader understands. You only increase capital after the system has proven stability, not increase capital to prove the system. Those are completely different things. Many people borrow money because they think, with big capital, I can trade properly. No, you trade properly first, or then you deserve big capital. If you cannot make consistent profit with a small account, borrowing more money only makes you lose faster. The market does not change because your account is bigger. Only your emotions change. Imagine you trade a $2,000 account. Each winning trade makes $50. You're happy, but still calm. Now you borrow money to trade a $20,000 account. Each winning trade makes $500. Sounds attractive. But each losing trade also loses $500. Are you truly as calm as before? And if the answer is, I'm not sure, then you're increasing risk faster than your psychology is maturing. And that is the formula for collapse. Trading is not just a profit equation, it is an endurance equation. How much drawdown can you endure? How many consecutive losses can you endure? How many sideways days can you endure? When you borrow money, that endurance threshold collapses. Because you're not only enduring account drawdown, you endure trust drawdown, family drawdown, reputation drawdown. And when everything piles up, you break discipline just to escape that feeling. Many traders blow up not because they're stupid, but because they are pushed into survival mode for too long. Survival mode is not the environment for financial decisions. Survival mode is for running or attacking, and both are incompatible with trading. Trading requires calm, waiting, accepting being wrong, letting opportunities go. But a person in debt cannot let opportunities go. They jump at every movement because they fear missing one trade that could save them. And that fear of missing out makes them lose more. There is a safer path, slower, but more real. Start with small capital. Only increase size when you have at least 6 months to 1 year of consistent profit. Don't increase volume because of one big winning month. Don't increase leverage because you're excited. Increase capital by one principle. Profit feeds profit, not debt feeds profit. You want a $20,000 account? Let $1,000 grow to $1,200, then $1,500, then $2,000, then $5,000. Too slow? Maybe, but durable. Trading is an endurance contest, not a speed contest. You may spend the first 23 years just learning how not to blow up. But if you survive, the later years are where money begins to arrive. If you borrow money from the start, you cut short the learning process, and the market will teach you with a bigger bill. A mature trader knows their forbidden zones, not which pair, not which time frame, but which psychological state. And borrowing money to trade is a clear forbidden zone, not because you can't win, but because it's too easy to self-destruct. You don't need big capital to succeed in trading. You need enough time. Enough time only exists when you don't have pressure. Pressure turns every decision into urgency. Urgency turns probability into emotion. Emotion turns a system into chaos, and chaos ends in a blown account. If you're at the stage of wanting to borrow money to trade, stop. Ask yourself, am I trying to make money or am I trying to prove something? Am I building a foundation, or am I trying to skip steps? Can I accept 1 year of slow progress, or do I need results immediately? That answer reveals what kind of trader you are. Trading is not a place to solve urgent financial problems. If you need money fast, trading is the worst place to look for it, because the market doesn't pay by your needs. It pays by probability. And probability doesn't care that you're in a hurry. In the end, remember this. When you borrow money to trade, you are placing your future on a variable you cannot control. But when you trade with money you have, you are placing your future on your own discipline. One depends on the market being right. One depends on you following the process. And in the long run, only the process can protect you. Never borrow money to trade, not because you are weak, but because you are smart enough to know you don't need to gamble to prove anything. There are clear signs. But because of greed, because of pride, because of hope, people often ignore them. The first sign is you start watching P&L more than market structure. Before, you analyzed supply and demand zones. You waited for confirmation. You read price action. But under borrowed money pressure, you enter a trade and your eyes glue onto the profit and loss number. Every small tick makes your heart jump. Every red candle makes you sweat. You are no longer trading setups. You are trading feelings. The second sign, you start calculating profit by bills. This trade must make at least $500 to cover this month's interest. Just one more trade and it's enough. Trading doesn't work like that. The market doesn't know how much you need. The moment you set profit targets based on debt obligations, you step out of probability logic. The third sign, you no longer dare to cut losses according to plan. Before, you set a 1R stop loss. Now, you widen it, then wider. You tell yourself, it will come back. But what you're really saying is, I can't tolerate another loss. That's no longer trading. That is refusing reality. And the market is brutal toward those who refuse reality. The fourth sign, you increase size after a losing streak. Yea, not because the signal is stronger, but because you want to recover fast. This is the most dangerous point, because it combines debt pressure and ego. You don't just want the money back, you want to prove you weren't wrong. And when trading becomes a tool to protect the ego, you already lost before you entered. There is a concept many traders ignore. Financial pressure distorts perception. Financial pressure bends your perception. You will see signals where there are none. You will believe the scenario that benefits you. You will ignore conflicting data. That is the brain's defense mechanism. But in trading, that defense mechanism kills you. I once met a man. He borrowed money to trade commodities. At first he said clearly, I will be disciplined. But when his account dropped 15%, he began changing strategies, from swing to scalping, from H4 down to M5. Because he thought faster wins would recover faster. In reality, he was running from the truth that he entered the game with too much pressure. And in the end, he didn't just lose the account. He lost the relationship with the lender. He lost his family's trust. He lost his confidence in himself. The most painful thing in trading is not losing. It is losing while knowing you shouldn't have done it that way. Borrowing money to trade is that kind of decision. You know the risk. You know the market is uncertain, but you still do it. Because you believe you will be the exception. But trading does not reward blind belief. It rewards risk management. A professional trader can use leverage, but they never use money that demands interest. They never put themselves in a position where they must win. They understand their advantage is not in winning one trade. It is in surviving long enough for statistical edge to work. When you borrow money, you shorten your survival time. And when survival time is shortened, the edge cannot even activate. That's why many people say, my system is good, but I still blew up. The system wasn't wrong. The risk structure was wrong. They built a house on borrowed foundation, and when the wind hits, the house collapses. Here's a very simple self-check question. If tomorrow your account goes to zero, does your life collapse? If the answer is yes, you are risking too much. Trading should only use money that if lost, you can still live normally. Still sleep, still eat, still smile. Because when you preserve that normal state, you preserve the ability to make clear decisions. A strong trader is someone who can lose without panic, can win without mania, Borrowing money to trade takes both away. You panic when you lose, and you get greedy when you win. Both are the shortest road to blowing up. Trading is a profession of balance, not a profession of extremes. And borrowed money is the fastest factor that pushes you into extremes. If you already borrowed money to trade, the first thing to do is not to win it back. It is to reduce risk, reduce size, accept slower progress, prioritize repaying debt over making big money. Because no profit is worth more than psychological peace. Money can be earned again. But your family's trust and your own trust in yourself is hard to rebuild once it breaks. In the end, remember this. Trading is not an escape from financial pressure. It is an environment that amplifies that pressure. If you enter with borrowed burdens, you force yourself to run while your legs are tied. A wise trader does not try to move faster than the market. They try to stand stronger than the market. And standing strong only happens when you don't place yourself in a position where you must win. Don't borrow money to trade, not because you are not good enough, but because you are awake enough to understand the market is not a place to test luck with borrowed money. In trading, there are two types of people. One type breaks easily. One type becomes stronger the more it gets hit. That concept is called anti-fragile, not just able to endure risk, but able to benefit from volatility. But to become an anti-fragile trader, you must do the first thing. Remove anything that can kill you after one fall. And borrowed money is exactly that kind of factor. A fragile trader is someone who collapses after one losing streak. An anti-fragile trader is someone who can lose 10 trades in a row, and their system and life are still intact. Where is the difference? Not in technique, not in indicators. It is in risk structure. When you borrow money to trade, you put your entire system into a fragile state. All it takes is one strong volatility spike, one unexpected news event, one liquidity sweep. And you don't just lose money, you lose the ability to continue. Anti-fragile starts with one simple rule. Never put yourself in a situation where one mistake means you can never come back. That's why professional traders always keep risk per trade small. Don't all in, don't martingale, don't borrow. They don't try to maximize short-term profit. They try to minimize risk of ruin. Because they understand one thing. As long as you exist, you have a chance. You can lose today, lose this week, lose this month. But if you still have capital, still have calm, and still have a system, you can come back. But if you borrow money and blow up, you don't just lose capital. You lose the chance to return with a healthy mind. That is the difference between a long-term player and a gambler. Anti-fragile trading is not never losing. It is designing the game so that losing does not kill you. Look back for a moment. Why do people borrow money to trade? Because they want to jump, to accelerate, to break through. But the market does not reward acceleration. It rewards speed control. An anti-fragile trader increases capital slowly. They let profit feed profit. They only increase size when drawdown no longer costs them sleep. They don't increase because of greed. They increase because their capacity to endure has grown. Imagine you are a fighter. You haven't trained enough, but you want to step into the ring against the champion. Borrowing money to trade is jumping into that match before your body is ready. Anti-fragile is a training process. You start with a small account. You learn how to take small losses. You learn how to wait. You learn how to not enter when there is no setup. You learn how to skip opportunities. Each time you lose, you don't lose everything. You lose a small piece, and you learn a big lesson. Over time, skill grows. Your nervous system becomes stronger. Then increasing capital makes sense. But if you borrow money from the beginning, each loss is no longer a lesson. It becomes a punch to the mind. And when lessons are too painful, you stop learning. Only defense and panic remain. There is something even deeper. Borrowing money to trade doesn't just destroy the account. It destroys your relationship with the market. The market becomes the one that must pay you. You see every movement as a chance to repay debt. You see every pullback as an enemy. You no longer respect the market. You try to force it. But the market cannot be forced. You can only adapt. And adaptation requires mental stability. Mental stability cannot exist when you are in debt. Anti-fragile trading requires one thing: separating emotion from short-term outcomes. But borrowed money makes that impossible, because short-term outcomes decide your financial condition. So, how do you build true anti-fragile thinking? First, accept that getting rich fast in trading is a dangerous illusion. If you want fast, you will accept big risk. Big risk leads to a high probability of ruin. It's second, build a system where max drawdown does not exceed your psychological threshold. If you can't handle a 15% drawdown, don't trade a structure that can lose 30%. Third, never use money you need for life. Living expenses, family money, borrowed money, all of it must stay outside trading capital. Fourth, treat trading like a business. A business doesn't borrow money to gamble. A business borrows when it has stable cash flow and a clear plan. If you don't have a 12-year stable track record, you are not a business. You are still learning a craft. And a learner should not borrow capital to expand. In the end, anti-fragile doesn't come from winning big. It comes from not dying after losing. The market will always be volatile. There will always be crashes, spikes, unexpected news. The question isn't, how do I never be wrong? It is, when I'm wrong, can I still stand? Borrowing money to trade makes that answer fragile. But trading with money you have, small risk, big patience, you can fall, but you don't break. And in the long run, the one who doesn't break always beats the one who tries to fly too high. Trading is not a contest of who is more reckless. It is a contest of who stays more awake. And that wakefulness begins with one very simple decision. Don't borrow money to gamble with probability. If you've read this far, maybe this thought has crossed your mind. Just borrow a little, just one more wave, just this one time, win big, I don't blame you. Because I understand that feeling, the feeling of wanting to escape fast, wanting to break through, wanting to prove you're not ordinary, especially when you're young. When you look around, everyone is showing achievements. Everyone talks about financial freedom. Everyone talks about opportunity. And you fear being slow, fear missing the train. But listen to one honest truth. The market is not the last train. It doesn't leave tomorrow. It will still be there in 5 years, 10 years, 20 years. Opportunities don't run out. Only the people who remove themselves from the game by recklessness run out. You don't need to get rich in 1 year. You need to exist for 10 years. Young people often think, I can handle risk. But risk in trading is not just losing money. It is losing trust in yourself, losing your family's support, losing time to recover psychologically. One blow up with borrowed money can cost you 23 years to stand again, not because of money, but because of the crack in your mind. You start doubting yourself, doubting the system, doubting every decision. And then, every entry carries the shadow of the past. Trading is a profession that requires a clean mind. Borrowed money makes your mind dirty. Dirty with pressure, dirty with fear, dirty with the obsession to recover. There is a hard truth. You don't need more capital to succeed. You need more time. But time is not exciting. It doesn't give instant dopamine. Borrowing money gives you the feeling, I'm doing something big. But in reality, you are only increasing fragility. Imagine 2 roads. Road 1, you trade a small account. You grow 35% per month. Slow, but steady. After 1 year, you're up 4,060%. After 2 years, you can double. No one applauds you, but you are solid. Road 2, you borrow money. You use leverage. You make 50% in 1 month. It feels peak. Then next month, you're down 70%. Nothing left. Which road do you choose? The biggest trap in trading is not the market. It is the ego. The ego that wants to prove, wants to be superior, wants to be ahead. Borrowing money to trade often isn't logic. It's ego. It's fear of being behind. But the market doesn't care about your status. It only cares whether you manage risk. A mature trader doesn't try to accelerate. They try to reduce mistakes. They don't ask, how do I make more? They ask, how do I not lose what I already have? And the first answer is always, don't borrow money to gamble. I want to say this directly to young traders standing at this decision. You don't need to be reckless to become someone. You don't need to borrow to prove you're good. If you truly have an edge, if you truly have discipline, if you truly understand the market, then small capital can still grow. And if small capital can't grow yet, big capital will only make you fall harder. Don't push yourself into a must-win state. Keep the right to be wrong, because the right to be wrong is the foundation of learning, and learning is what creates sustainable money. One day, when you look back, you won't be proud that you once gambled. You will be proud that you were awake enough not to gamble. Trading is not a place to bet with borrowed money. It is a place to train calmness, and calmness exists only when you are not cornered. If you are thinking about borrowing money to trade, it's stop for 1 week. No trades, no calculations, just sit still. Ask yourself one question. Do I want to get rich, or am I afraid of being slow? If you are afraid of being slow, remember, slow doesn't kill you. Reckless can kill you. The market does not reward the brave. It rewards the disciplined. And discipline begins with saying no to decisions that make you fragile. Never borrow money to trade, not because you are weak, but because you are mature enough to understand, sustainable always beats fast. And the person still standing in the game always has a chance to win.